Hello and welcome to my monthly update on the alternative asset management industry and the service providers and their league tables. In terms of the service provider ecosystem, there are over 600 fund administrators, 500 audit firms, 300 primes, and over 1,400 custodians servicing the private markets. I am George Evans from Convergence. Convergence is a data and analytics firm focused on the asset management industry globally. Note that alternative asset management league tables are available only to Convergence clients. League tables, though, can be purchased at the Convergence e-commerce site. I will provide some commentary on the movement we saw from January 2020 to January 2021 in the market. I will be joined this month by Jeff Gendel, who is one of the key principals at Gen 2, as you know, a very large fund administrator, particularly in the private equity space. I have some exciting news I want to share, though, in terms of the expansion of our offering. For years, we've provided administrator and audit league tables, and we've done that just from a U.S. perspective. We've now expanded that to 3 views. One is a global view, one is a U.S. view, one is a non-U.S. view, and we're doing that continuously for fund administrators and fund auditors. We have also expanded our league tables, and we are launching the inaugural custodian and prime broker league tables. So we will now be on a monthly basis giving you that same view on custodians and primes relative to kind of a global market share, U.S. market share, and non-U.S. market share. I want to welcome our guest this week, Jeff Gendel. For those of you who don't know Jeff, which probably many of you do, Jeff is a principal at Gen 2, and Jeff has overall responsibility for business development at Gen 2. Hey, Jeff, welcome. I'm glad you could join us today.
Thanks very much, George. Glad to be here with you.
Well, listen, it's good to see you. And let me start on this front, Jeff. You know, I want to talk about the PE market, right? And as we kind of are coming out of this whole 2020, 2021, let's call it, you know, post-COVID environment, you know, wanted to get a sense of your views and how you're feeling about the PE market going into 2022. Really, you know, how bullish are you guys, and what are you thinking is from your perspective, kind of the focus of the firm in 2022?
Mm-hmm. Well, thanks for that question, George. Look, we are long-term bulls on the private equity market. We've been long-term bulls for the last dozen years since we started Gen 2. Private equity is a long-term game, and sure, there's going to be some gyrations and there's going to be some hiccups, and maybe COVID is going to put a damper on fundraising, or maybe dislocation in the tech markets that causes a fall in the public markets is going to cause some stop in fundraising. But I think that private equity has always found the ability to be nimble in good markets and bad. And if you look at private equity consistently over a long period of time, it continues to perform. So again, we're long-term bulls on private equity. Will 2022 be a more robust year than 21? Well, I think that the fundraising market is going to determine that. I think we're probably a little tapped out in certain segments of the market, but not others. But overall, we're continuing to be very excited about not just 2022, 2023 for the general private equity market. It continues to be a place where more assets flow from limited partners. It continues to be more widely accepted in around the globe from new institutional investors. It continues to be more widely accepted by high net worth individuals and pension and individual IRAs and individual retirement accounts. So we think that the winds continue to be at the back of private equity. Obviously, there's some things that could impact tax policy, monetary policy, fiscal policy, big macro things. But the overall trend continues to be very positive, and we're glad to be along for the ride in the market.
Well, I think what's great, and I think that's well said. I think what's great, Jeff, is you guys were clearly one of the first movers in this market, and continue to be fairly dominant, and I'm very well positioned, I think, as a firm, for that growth. Now, on that front, right, the competition continues to heat up, right? We all know that closed-end growth has been much more substantive than than hedge funds, and especially in terms of not only asset flow but new fund formation. Without giving away the secret sauce, right? One of the things I was hoping you could chat a little bit about is, just in general, what do you think has differentiated Gen 2, compared to the many players out there, right? And a lot of those players have kind of gone, as full bore into closed end, right? And but curious, how you think about your firm versus the competition these days.
Well, I really like our market position. We have fantastic competitors. Don't get me wrong. We have fantastic competitors who are very smart and have built very good businesses. But I think what helps us and differentiates us is our focus on our asset class and the subject matter expertise that we bring to bear for our clients. That's what they look for us to provide to them. They know we understand the products that they create. They know that we are going to deliver for them on a service basis. We're going to deliver for them at the highest levels of service. They know that the investments that we make into our business are back into the products that they create, and that we're investing back into our team that allows us to create scalability. They know that we're investing in technology. Again, all with the expectation of servicing their future needs. We look at our relationships as long-term, 10-year, 12-year, 15-year relationships, because that's the fund size that they're raising, right? And so our ability, a demonstrated ability to be able to meet their service needs as they're growing in funds, as they're growing in strategies, as they're growing in service needs, that's what our clients rely on us for. We are expecting to continue that growth for them, and we're not going to be distracted by other asset classes that are not where our clients are focusing their time and effort. So I think our focus has certainly differentiated us in the marketplace. Our expertise has differentiated us in the marketplace. Our service delivery and the transparency that our technology provides, those have all been differentiators. And I think we continue to be innovators in the marketplace. And the one thing that I'm constantly impressed with when I talk to firms that we have pitched and won is that, hey, look, you guys promised something and you delivered on it. And there's no better endorsement of the firm and the people that I work with every day when a client who we promised something says, yeah, you guys actually delivered on it, and I'm delighted for that relationship. So I think those things, look, every one of our competitors, they all have their good qualities. They all do a good job. It's a good industry to be in. But I think those are some of the differentiating factors that have propelled us to the position that we're in today.
Yeah, I think that's well said. When I think about you guys, and I go back with some guys at the firm a long time. The subject matter expertise is of paramount importance, and the reputation I think that Gen 2 has for that subject matter expertise and that pedigree, right? The pedigree of people like you and the other leaders in that firm, I think is stellar, and you don't see that I think everywhere. And you don't see it as consistently, I think, as you see it at Gen 2, right? So
thank you for that, George. And just let me say, I mean, that when I joined Gen 2 8 years ago, that's one of the things that really attracted me to the organization is the quality of the people that I saw within the organization and the long-term vision that they had to build the premier firm in the space. And not get distracted by things that were outside of their remit. And so, as you rightly said, the pedigree of the people that are at Gen 2 is of the highest levels, and that I think speaks to our ability to deliver on that service quality that I mentioned earlier. You have people who really understand the business, who really understand private equity, who really understand the future of the industry and how we can solve problems for our clients. And that ongoing conversation has yielded excellent results for our clients and ultimately for us.
Yeah, I agree with you. Okay. A great topic in fund admin is M&A, right? And I always laugh. There are now over 650 administrators. There's clearly the 80-20 rule, right, in terms of where the business is. But I think when we started Convergence in 2013, there were 400 administrators. So much for, consolidation. But I did want to get your thoughts on fund administration, M&A, and maybe just to set the table. So in 2021, there were 22 acquisitions. 13 of them were by European fund administrators, right? And then the others were by North America. Just your thoughts on it generally. To me, it's a great way for people to add add some scale, add technology, add people, add geography, all the reasons you add product, all the reasons you do it. But I wanted to get your sense on, do you see that continuing? And what's your view just from a Gen 2 perspective on it?
Well, there's been a lot of M&A and a lot of entry into our market because it's a good market. It's a good business. If you do it right, it's a good business. And if you do it right, your clients are loyal to you, and you can grow and you can create value for your clients, ultimately value for yourselves and those who have invested in your business, whether that's employees or outside shareholders. So it's a good market to be in. You mentioned about European firms coming over to the U.S. and making the majority of the small majority of the acquisitions. I think that you well know the market in the U.S. is still not 100% outsourced. It's not going to be 100% outsourced for a while, as opposed to Europe. And so if you wanted to capture the biggest growth engine in fund administration, the U.S. certainly seems to be the place to do that. So we think that there will be more M&A. I can't tell you if we're going to be at the forefront of that M&A. We're going to be very smart about how we make our acquisitions and make acquisitions that make sense for the firm and for our clients, rather than just being an acquirer for acquirer's sake. This is, again, as we talked about earlier, Gen 2 is run by people who really understand this business, I think, better than anybody else, or as well as anybody else. I can't say better, but certainly as well as anybody else. And so that knowledge of the market is going to drive us to make acquisitions that are going to benefit our current clients and set up ourselves to win new clients that we might not have won if not for those strategic acquisitions. So we're going to be thoughtful about it. We're going to be careful about it. And we're going to do what ultimately is going to benefit everybody in our orbit. So that's our plan on a short-term basis.
You guys were very smart about some of what you did over the last 12 or 18 months, right? It was I think very deliberate and very strategic. Yeah, I think it's active, like you. I think we're going to continue to see it. And I think to your point, listen, this is a $25 trillion market, right? With a lot of misalignment, meaning there are people with administrators that they should and shouldn't be with. And to your point, almost 30% of this market is still that administration is still done in-house, right?
Yeah.
And most of that's closed end, right?
That's going to be the growth driver for many of us, and that's again the reason why many of the Europeans, where it's almost 100% outsourced, are coming to the U.S. to find market opportunity. The other thing that's happened, George, you talk about M&A, is there's reasons to make acquisitions, cost reductions, scaling a business. One thing we all know is it's become a lot more expensive to be in the fund administration business these days compared to what it was 5 years ago. You think about the regulatory environment that we all live under. You think about the data protection needs. You think about the cybersecurity needs. Just simply look at due diligence that LPs perform on GPs these days and the number of questions that they ask, which essentially mean that the GPs and then the service providers that support those GPs, ourselves included, need to have invested in our business and in our processes and in our technology and in our infrastructure to meet those demands from those LPs. Otherwise, they're not giving the GP money. So that entire effort costs a lot more. It's a lot more capital intensive than it ever was. And so if you are looking at the future as a fund administration firm, you're saying, well, wait a minute, I need a lot more capital to be able to win that next mandate, because those LPs are asking those GPs to evidence via their fund administrator certain characteristics. If we're not able to do that, well, then we might be subject to some sort of transaction in our business. And I think that's happening with certainly some of the smaller players in the business. That combined with, as we said before, look, it's a good business. And if you do it right and your clients see the value, they're very loyal. They stick with you. They give you more business. So there's a couple of factors at work that are contributing to the additional M&A that we've all seen over the past several years. Don't have a crystal ball, and I couldn't tell you if that's going to continue. But again, it's more expensive to operate in our business. It's more complex to operate in our business. And I think that combined with the opportunity that many see in the U.S. market, and frankly, other markets and other ways to grow your business, I think that's driving a lot of the M&A.
Yeah, and last point on that, you're well aware, like anyone, that the premiums being paid right now are sometimes just outrageous, and we're actually seeing some firms, for a growth perspective, pivot to a little more of a lift out strategy, meaning take over a middle and back office selectively by advisor, and they're finding that to sometimes be a little more economical than just going out and buying something lock, stock, and barrel. So it's an interesting time, Last question, and you've been around the block, so I want your view on this. Is the advisor, your client, right? The type of people that you service. How do you see that advisor changing these days? And what do you, some views on what maybe I'll call the next generation advisor, right? What if you had to look at the couple things that over time that you see are different, at your clients, at advisors? What do you think they are, Jeff?
Well, I think that the transparency that LPs are looking for is only going to ramp up, right? You hear about a lot in the marketplace. I don't think that the LP community has been 100% aligned, right? You talk to different LPs on something like ESG, and different LPs want different things, right? So the transparency on things like ESG, the transparency. Look, we just had a week's worth of articles about the SEC and their requests for more information from private equity firms and more disclosure on fees paid. So I think that the need for transparency is going to impact the private equity firm. The next generation advisors got to be ready to go, jump out of the gate with a more transparent and open infrastructure. They do that through a combination of the service providers that they work with and their own internal operations. So that next generation advisor is going to look a lot more like a public organization as opposed to a truly private organization. That's one of the things that I think is going to happen over the next several years. And the SEC's pronouncements last week, if passed, are going to accelerate that activity. So that's one place where they're changing. I think, like, on a firm by firm basis, they're going to decide if they want to get into different asset classes, if they want to go into private credit, or if they want to go into something more long dated. I think you're also going to see if the individual investor market continues to grow at a faster pace than it's grown. Or you have firms like iCapital and now Moonfair and Case who've done a wonderful job at building businesses that enable high net worth investors to get into the marketplace. So I think that the next generation advisor has to make a decision how they want to engage with the high net worth marketplace. And I think that the next generation advisor, none of us really know how the LP landscape above the high net worth individual is changing. But I think that the next generation advisor is going to have to learn how to compete on a global scale for capital. How are you going to be able to attract capital constantly from around the globe? And does it need to be in a traditional 10-year fund structure? We've seen a huge rise in continuation funds recently. And I don't know what's going to happen in the future, but does that mean that the old model of a 10-year fund is out the window? I don't know. But that's an interesting phenomenon that's happened in the last 18 months to 2 years, this continuation fund concept. And what does that mean for the creation of new private equity vehicles and the ability to change how they're structured down the road? What do you build into today's LPA that can help both the GP and the LP in 5 years, when, if not for any language in there, a continuation fund might come in and take an asset out and put it into a new entity. So the next generation advisor is going to have a different type of LPA. I think they're going to have a different LP base, especially if they're going to go full steam after the high net worth investor. And I think they're going to be going after a global capital base. And then lastly, as I started off with, I think the transparency that they need to evidence, whether that's on ESG, whether that's on underlying fund KPIs, those are all going to play into the conversation in the next several years.
Yeah, no, great thoughts, and I agree with you. I think they're pretty interesting observations. Well, listen, I want to thank you for joining us this month, and yeah, it was great to speak with you. And you guys have been a great client of the firm, and I want to thank you for that. So appreciate it, and I wish you a really successful 2022, right? And in what you do for a living, you're only as good as the last deal you bring in, right? So it's early, and I wish you the best for the year, Jeff.
Thanks, George. I appreciate you giving me the opportunity to spend some time with you today and ask some questions that hopefully will be enlightening. And I look forward to getting your monthly snapshot of the market, because that'll tell us how we're doing.
Sounds good. All right, thanks, Jeff. Have a good day.
Thanks, you too, George. Be well.
All right, now I want to move to make some comments around really the 4 league tables and some of the market share shifting that we see in the marketplace. So let me start with fund administrators and the league tables. I'm going to first take a global assets under administration view. When you think about the top 25, you do see quite a range. And when you look at our league tables, you see that range starts at almost 7.1 trillion for the largest global fund administrator, and number 25 is around 285 billion. So there's quite a mix of global administrators, and really the top 10 tend to move between about a trillion and 7 trillion. When you think about growth in the market, we saw over this last year admins ranked 11 to 25, really registering the highest AUA growth in the market, over 25%, and that admins over number 25, so 26 plus, with the lowest AUA growth. So their AUA growth actually declined almost 10%. So we're clearly seeing kind of a flight to the top globally, and I think a very interesting phenomenon beyond the top 10, right? Particularly numbers 11 to 25. On the auditor front, when you think about global assets that are being audited, and you think about the top 25, the big 4 clearly dominate in terms of asset size. Price Waterhouse at 27 trillion, Ernst at 10, Deloitte at 10, KPMG at 6 trillion. Then we go all the way down to about 21 billion in the top 25. So quite a vast range for global assets. And administrators, we saw auditors ranked 11 to 25 registering the highest AUA growth, and that growth was around 31%. And auditors 26 on grew at about 12%. When you think about our new tables now, and we would start with prime brokers, one of the comments I want to make is we are measuring primes based on fund growth. Asset growth is not a measurement that in terms of market share. As you know, a prime broker is more interested in the balances that they have. But one of our initial measures here in the inaugural prime broker league table are our fund level. So when you look globally at the top 25, you also see quite a range, right? You see the top provider of fund, of prime brokers services to funds is Goldman Sachs, with close to 5,000 funds. And number 25 is almost just about 125 funds. So you really see in the primes much of the activity here in terms of current market share in the top 10. However, we see that same phenomenon in terms of growth, right? Primes 11 to 25 had higher growth than 1 to 10 at about 7% of the funds. When I compare that to the top 10, they grew at about 3%. So, the top maintains kind of the the dominating position, but we are seeing people kind of go down market on the prime front. And then lastly, I just want to make some comments about custodians. As you know, that there's 1,400 of them, and when I look globally at custodians, you look at the number one custodian in the market, the alternative market, at 19 trillion. And then you go down to number 25, it's about 800 billion. And in this market, you know, most of the top 10 are between about 3 and 7 trillion. And then really the top 3 that dominate in this market, JP Morgan, State Street Bank, and the Bank of New York, are all in the mid to high teens, right? So clearly there's a skewing here also in terms of custodian market share. Interesting fact here, though, that the custodians 26 and on registered the highest asset growth of almost 16%, whereas 11 to 25 grew at about 14%, and 1 through 10 grew at about that same level. So kind of neck and neck, right? Everyone's around 14, 15%. But this is kind of the first in a series of monthly league tables where we will now show you admin, audit, prime, custodian growth. We're going to show that on 3 levels, right? We're going to show that globally. We're going to show that from a US perspective, and we're going to show that from a non-US perspective. And then we're always going to talk about where we see business going, where we see growth, growing and or declining. And it's a very good measurement, I think, in terms of you know, really where the service providers industry is headed in terms of you know, the top 25 and the top 50 and beyond. So I want to thank you. I want to thank Jeff for joining us, and as always, we appreciate you listening, and we look forward to seeing you next month.